This golf cart life along the Carolina coast can be expensive, or some say it can be inexpensive. What does it really cost to live here along the Carolina coast? Let's talk about it right here today on Coastal Living with Phil T. Hey, what's going on? Welcome to Coastal Living with Phil T. One of the biggest misconceptions about moving to the Grand Strand might be how expensive people perceive it to be or how inexpensive folks might think it may be. Today, we're going to uncover the truth on what it really costs to move to the Grand Strand. The truth is somewhere in the middle. Yeah, that's the simple truth. But what does it really cost to move to the Grand Strand? Today, I'm going to break it down. Every major cost you'll need to consider before making the move, from buying a home to insurance, HOA fees, utilities, and even some financing options you didn't even know about. Today, we're going to talk about it right here, right now. By the end of this video, you'll have a much better idea whether moving to Myrtle Beach fits your budget. So what does it cost to buy a home? Well, it really depends where you're looking at. Places like Conway, you'll find houses a little bit cheaper because you're a little further away from the beach. Also areas like Aner, Nichols, and out in the outer Horry County areas. Carolina Forest, you'll start seeing an increase in pricing due to demand and the amount of people that are moving there right now. Surfside, also because of the limited demand and area, homes will be in the mid to $400,000 to $500,000. Murrells Inlet, you can find a nice house in the $300,000 to $400,000 and up. Pawleys Island as well, you can find homes due to limited supply starting in the $300,000 to $400,000 area, and North Myrtle. Now, it also depends whether you're east or west of 17. That'll definitely determine how expensive the house is. When looking in the price range between $250,000 and $350,000, you'll find older homes more inland, not always on the west side of 17, but usually. Also, some condos and smaller homes that might need some fixing up. This is a great budget for first-time buyers, retirees trying to stay within a budget, and of course, budget-conscious buyers. In the Grand Strand, if you're looking for a home between $350,000 and $500,000, you're probably going to be looking in the Carolina Forest, Conway, Murrells Inlet area, and some in Surfside. Realistically, you'll be able to expect a 3 to 4 bedroom house of 17 to 2,300 square foot and a nice neighborhood within that budget. If your budget happens to be between the $500,000 and $700,000, you're going to be in golf communities or even closer to the beach in towns like Surfside. Also, maybe closer to the marsh in Murrells, Pawleys Island, and you'll find larger lots in that price point. When the budget gets closer to $750,000 and $1 million, you can pretty much expect that you can buy a good amount of home. Definitely a luxurious home if you're looking in certain areas or maybe even closer to the ocean. You won't find anything oceanfront under $900,000 at this time. You could also find your house on any golf course throughout the Grand Strand area, or also the waterfront on the intercoastal can sometimes be found in the $900,000 range. But $750,000 overall in the Grand Strand can find you a really nice house. The problem is the purchase price is only one part of the puzzle. Let's put the rest of the puzzle together, starting with a down payment. So one of the biggest misconceptions is that you have to put 20% down to buy a house. I hear it all the time. In fact, it's almost right off the bat. Hey, I'm looking at a property. Do I still have to put 20% down? Well, it really depends what type of loan product you want to go with. Okay, we'll start out with conventional. It's probably one of the most used out there. It's very common that most folks will put anywhere from 3 to 5%, depending on the lender and what type of credit you have. And like I said, 3 to 5% of the purchase price can help put a little money aside in case anything comes up that you need to pay for. Now, this is for this is for owner-occupied purchases. If it's a secondary home or an investment property, you probably won't be able to put down 3 to 5%. You're probably looking at 20%, but some folks out there and some lenders will actually honor 10%. So it all depends really on the lender. The next one I want to talk about is FHA. FHA, 3.5% down. But it has to be your primary home. Nobody will allow you to use 3.5% FHA financing to go ahead and buy a property that will be an investment. This is great for first-time home buyers as well as folks who are still working on their credit. Now, just understand, if you're putting down 3.5%, 5% with conventional, you're going to have something called mortgage insurance. What that does is it covers the gap between whatever the percent you put down and that 20% threshold that goes that most lenders would like. Now, that mortgage insurance is going to cover that amount. And it's going to come out of your payment every month, or excuse me, be added to your payment every month. And it just depends totally on which type of program you go with, as well as how much money you're putting down. Sometimes it can be a substantial cost, so you definitely want to look into that before you decide how much money you want to put down on either program. One of my favorites to work with is definitely the veterans or VA loans. This is probably the best loan available. Sometimes you don't even need to put a payment down, but there's a lot of requirements, one of which is that you are a veteran. Make sure you talk to your lender about the options for veterans. And of course, always feel free to reach out, as I'm always happy to help those that have served our country and do everything I can to get you in a property. So if you're looking out in the country, a great loan program you might be interested in might be something called a USDA loan. This has to be done, though, outside of the Myrtle Beach area. In fact, take a look at this map right here, and it shows the areas that you cannot use the USDA loan, and then the areas you can. You'll see areas like Conway, Loris, Aner, and Nichols as some great options for USDA. Now, the thing about USDA loan is it's very flexible with credit. So if you're still working on yours, you can use it. Plus, you also can get up to 100% financing, which is great. You have to use it on a primary property, though. So check out the options for a USDA loan, as it might be a great choice. Your down payment affects not only as much cash as you'll need up front, but remember, it also affects your monthly payment. For every so much you put down, it takes a lot off your monthly payment. So keep that in mind as well. Unfortunately, closing costs can be one thing folks forget about a lot. And though I can tell you an estimated closing cost, you should really ask your lender on what they charge, especially considering lender fees can sometimes add up to be pretty substantial. Other fees you might have to incur: attorney's fees, as well as appraisals, inspections, recording fees, prepaid taxes if you're getting a mortgage, as well as insurance and escrow accounts. Sometimes they want to hold up to 3 months of taxes and insurance in your escrow. So make sure you talk to your lender about what to expect your closing costs being when you go to the table. The good news is, though, sometimes, depending on your situation and the offer, we can actually negotiate a seller paid closing cost. So that way it's money you don't have to come out of the pocket on closing day. So you find a $450,000 house. It's the house you've always wanted. It's the dream home, but what will it cost every month to own? Well, that's a great question, and I'd like to help you out. Now, this is an example only. This is your primary residence with 5% down, 30% year fixed, 30-year fixed mortgage at roughly about 6.5%, which is kind of the average right now in the market. I'm going to run some numbers for you right now, and then I'll show them right over here as well. Your mortgage, say roughly every month, you're going to pay about $2,700. Now, that's principal and interest only. Your property taxes, it all depends on where the property is at within the Grand Strand area, but or even the Carolina coast, but that looks about $130 a month. Your homeowner's insurance, once again, it all depends. Are you on the east side of 17? Are you on the west side of 17? Are you out in the county? Where are you at? It just depends on how much your homeowner's insurance will be, but that'll be about $275 a month. When it comes down to wind and hail, that sometimes can be separate than your homeowner's insurance policy. Homeowners covers if someone comes over to your house, trips, falls, gets hurt, or something happens to the house itself that has nothing to do with wind or hail. Wind or hail deals with named storms, as well as high wind and, well, hail. High wind and hail insurance is usually separate from your homeowners, but sometimes can be grouped in together. And you're looking at about $125 a month for that. Flood insurance, it really all depends where you're at. We've gone over it time and time again that flood insurance is very specific to the property in which you are purchasing. You could look to spend between $0 to $200 a month. Yes, that's a month on flood insurance, or even more. So you definitely want to make sure that you're in a flood zone or not in a flood zone, and how much you're going to spend a month, because that could really change your budget. HOA fees, we'll just say roughly $75 a month. They do fluctuate depending on the neighborhood and the amenities. Your PMI, which is that private mortgage insurance, because you're only putting 5% down, is going to be roughly about $140 a month. Your estimated monthly payment puts you at $3,245 a month without flood insurance. If you do have flood insurance and say it is $200 a month, then you're looking at $3,445 a month. Let's keep this going. Okay. So you bought this house, or you're looking at buying this house. What do you need cash up front to close? So this is totally if we get no seller paid closing costs, which, like I said, I am going to try my best if that's part of our negotiations with this seller to go ahead and get you some, so that way you don't have to come out of the pocket for it. Okay. 5% down is going to be $22,500. Your closing cost estimate is going to be between $8,000 to $12,000. And that totally depends on the lender, what type of inspections you get, and so much more. The lender's probably going to want prepaid taxes and insurance, so that way they can put it in your escrow account. So that could be anywhere from $2,000 to $4,000. Estimated cash to close puts you between $32,000 and $38,500. This is why two homes with the same exact price point can literally have monthly payments a few $100s apart. When it comes down to insurances, taxes, it can really depend on what area, what town, and where you're at in the Grand Strand. So you always want to run these numbers and make sure you're within your budget. We talked a little bit about insurance, and I always tell folks as we're in the process of buying a home, make sure you talk to your insurance agent. Sometimes even talk to your insurance agent before you make the offer. Why? Well, because homeowners can cost you between $2,800 and $4,800 a month. Wind and hail could cost you anywhere from $800 to $2,500 a month, and flood, depending on your zone, well, just regular flood insurance, not in a flood zone, could cost you between $350 and $700 a month. A year, excuse me, a year. Flood Zone X or even AE flood zone could cost between $800 and $2,500. And oceanfront, if you're looking for an oceanfront property, anywhere from $2,500 and up. So you definitely want to run that and put it in your budget, especially if you're looking at this property being an investment in the long run and you want it to make money. These numbers will really affect your outcome at the end of the year. HOAs can definitely fluctuate depending on the neighborhood and also the amenities. Of course, you have some HOAs that are voluntary. You also have some HOAs that are roughly $30 a month, and usually that's a neighborhood with a house that just takes care of the common areas and the streets. $75 a month, you're probably not getting many amenities. If you go up to $150 a month, there are some neighborhoods that do have pools available as one of the amenities for the $150 a month, but usually they're pretty big neighborhoods. $300 a month is where you usually get more amenities or a nicer neighborhood, and they go up from there. Maybe even security guard. They can go up from there. Now, when you go to condos, very rarely will you find condos in the $200 to $300 range a month, but you can find them out there. There are some great condos further away from the beach that do have those lower HOAs. When you get closer to the beach, and especially beachfront, you can expect to spend anywhere from $600 to $700 a month and more. It covers things like the pools, the roof of the building, as well as landscaping, insurance for the property, which is a huge one, and even security. It's important to know what the HOA covers and how much the HOA is every month. And if there's any assessments that are going to be coming down the line, you definitely want to know about them before you move forward with the property. So we ran the numbers on what it's going to cost for the monthly payment for a $450,000 house. What about everything else, though? Yes, I mean, if you think about it, your mortgage is just part of, we'll say, the pie. The mortgage varies, of course, depending on what your house costs and all that. As you saw, there's a lot of variables that are part of that payment. So that's kind of a fluctuating thing. Electric, $130 to $250 a month. It really depends on how many appliances you got plugged in and how much you crank up that AC or that heat. It just really depends. Water and sewer in this area is pretty affordable thanks to our friends at Grand Strand and other local municipalities. $60 to $120 a month. Internet can be anywhere from $60 to $100 or more. It just depends what exactly you need. If you work from home, you might need a higher paid or higher internet plan, which might cost you a little bit more. Me personally, I'm a huge fan of the 5G internet in the area because it seems to work really well and it's really affordable. So the nice thing is there are a lot of companies in that sector right now, so you can get a great deal on it. Even folks like SpaceX, who is absolutely great as well. Groceries, it all depends on your lifestyle and, of course, the size of your family. You could spend anywhere from $600 to $1,000 a month in groceries. It just depends. Gas is going to depend on your lifestyle as well. You could, maybe if you're retired, you're not going to be leaving the house very much. So you can get away with $120 a month in a gas bill. Well, others need to drive a lot. I mean, I probably spend about $200 to $300 a month on fuel myself. It just depends. Dining out, it depends how big your family is and how much you're going to want to go out. But overall, you can eat affordable along the Grand Strand. You can expect to spend anywhere from $200 to $600 a month out at restaurants and dining options. Golf. If you want to be playing every single week, maybe twice a week, you can expect to spend over $500 a week in golf. It just depends. Otherwise, you can expect to spend about $150 if you're only going out once every other week. Healthcare varies on your needs and, of course, your insurance and what it covers. Now, there's one thing in South Carolina we got to talk about, and that, of course, is your vehicle tax. It is an annual vehicle tax. The amount depends on the value and the age of the vehicle, but you could pay anywhere from $150 to $600 a month. It all depends on the size of the vehicle, the weight, and what type of vehicle and the value of it. So make sure you check out those items before you move forward because you definitely want to figure that out. Now, just to remember, that vehicle tax is per year. It is not per month. It's per year. So just keep that in mind as it may fluctuate your yearly expenses. So when it comes down to financing, we talked about the main types of financing, but there's other types of financing that are available. Folks just may not know about them. So I'll talk about them in a brief segment right here. But the thing you got to know is each one of these is its own type of financing, and it's all up to whoever you're buying the property from, and really what you are willing to do as well. And make sure you talk to an attorney or a CPA about any of these if you're worried that it's going to affect taxes or any kind of liability you have. The first one we'll talk about is seller financing. It's a pretty widely used option. It's also known as owner financing, depending which way you want to use it. It's where the person who is selling you the property holds a note for a certain amount minus whatever you decide to put down on it at the terms you guys discuss and come to term with. So you could have a property where you put 10% down, they're going to charge you 6% interest, and they'll give you a 30-year note with a 5-year balloon. It all depends on the things you negotiate as part of that. Subject to is a little bit different. Subject to I'll talk about, but you want to make sure you totally understand how it works. And in fact, it's very, very, very tricky to use, but I want to talk about it because it's something that some people do use. Subject to financing is when you're buying a property that still has a mortgage on it. Okay, so it might have a mortgage. Say you're buying a $200,000 property, it still has a $100,000 mortgage on it. You're giving the seller $100,000, and you're taking on that mortgage of $100,000. Usually, that mortgage still stays in the seller's name, though, which puts them at liability for moving forward. It's something you want to think about. You want to talk to your attorney about it. You want to make sure you totally understand how it works, because the other part is once that property does transfer from one name to another, it could be called due and you'd have to pay that money or they can foreclose on it. So once again, a very tricky type of financing to use, but it is something that is available if you know what you're doing. Portfolio loans, another option that's great out there for properties that are not conventionally or FHA approved. You want to talk to a lender about how that works. 1031, that's an exchange between one property of like kind to another. So if you have a piece of land you're selling and you're making so much off of it, you don't want to pay the taxes on it, the capital gain taxes, you can then buy another piece of property using that capital and not have to pay the gains on it. That, of course, is a 1031. Once again, talk to a CPA about that. Huge tax incentives there, but you have to know exactly what you're doing and how it works. Another option is a lease purchase, such as like a rent to own. Once again, you want to make sure an attorney is involved and you know exactly how much of that monthly payment every month is going towards the down payment of the house or the purchase of the house, because sometimes it can fluctuate depending on what you agree to. Builder incentives are a huge thing. Talk to a builder, find out exactly the incentives they are offering, because moving forward, you could really get a great deal on a new house with those builder incentives and move forward with it and not have to come off the hip as much for a down payment or maybe some seller paid credits or so on. The last one I want to talk about is a DSCR loan. This is found a lot on short-term properties or rental properties. A DSCR loan does not go against your personal income. In fact, it goes against the income of the property you are purchasing. It's a great loan product if you're looking for short-term options. The big thing is, though, you will be needing to put about 20% to 25% down, depending on the property and how much money it makes a year in rentals. Some of the biggest mistakes folks make when it comes to buying a property along the Grand Strand or really any area is not doing their research on what it's going to cost. Maybe they bought the house because it's really close to the beach, but that also is going to bump up other factors, including the price of the home, as well as the insurance and much more, which makes the house be a little bit too expensive. When it comes down to the HOAs, you ignored the rules that the HOA has. You want to rent it out. Well, you can't. Sometimes there are HOAs that say no rentals at all, long or short terms. That, of course, means you also want to check those rental rules. Even in an area that they say you can short-term rent, does the HOA allow it? You bought too much house. You're spending so much money every month heating and cooling this house that you spent way more on than you should have, and you didn't pay attention to that budget. These things will get you in trouble. So make sure you check your budget and make sure you keep it in mind while looking to buy a house. Don't overextend yourself. You can always buy a bigger house closer to the beach later on down the road. So you're wondering, can I afford it? Well, every buyer's situation is different. Some buyers qualify for more than they think, while others qualify for a little bit less, but realize they'd rather save that money and enjoy it on their lifestyle. So if you're wondering if you could probably comfortably afford living in today's market here in the Grand Strand, I'd be happy to put a plan together and discuss how you could see yourself living here at the beach. So are you interested in a property along the Carolina coast and you want to know exactly what it'll cost? I can give you a general idea by just reaching out with a comment below, or shoot me a text or give me a call. If there's other things I can help educate you about moving to the Carolina coast, leave them in the comments below. Subscribe and follow. Appreciate you watching this video. Thanks for watching Coastal Living with Phil T.